Number one is that if your money is sitting in a bank at the normal checking account rates, it will be losing value to inflation. The US Federal Reserve targets a 2 to 3% inflation rate per year to keep the economy healthy, and you can kind of feel that in your day-to-day life. As an oversimplified example, a Chipotle burrito 6 years ago cost me $8.50, and these days it's closer to $12. So if you had $50,000 in 2019, you could have bought 5,882 Chipotle burritos with that $50,000. However, these days, that same 50K can only buy you 4,166 burritos, and that's 1,700 fewer burritos. For what? Inflation? Now, I have a lot of ideas on what I could do with 1,700 burritos, but my point here is that inflation has made it so that you can now afford less with the same amount of money. So therefore, we need to make sure we're at least beating out inflation when it comes to our cash, and we can do so by investing it. The stock market as a whole returns about 8 to 10% per year historically over the past 80 years or so. So if we invest, we can reasonably expect that over time, we will grow our money at a rate at least faster than inflation. The second reason we want to invest is that you will often hear the phrase, it takes money to make money, and this is illustrated beautifully with the concept of compound interest. Pretend you have $1,000 generating you a 10% return per year in the market. That's $100 per year you are receiving for investing, which is nice, but it's not life-changing. In year 2, you would get 10% again, and now you'll have $1,210 because you're getting 10% on the now bigger sum of $1,100 at the end of year 1. Now, if you repeated this every year for 20 straight years, you would have $6,727.50 by the end of it. So just by putting $1,000 into your main account and getting a return of 10% every year, the money compounds on itself and grows bigger. Now imagine you had $1 million earning you a 10% return in the market. That's $100,000 per year that you are earning just for investing it. All that's really changed is how much you've invested, and you can see that the more money you have, the more money you will make. More money equals more leverage, so when you have more money to work with, the returns from having that money increases proportionally as the amount that you have increases.